The global economy is often described as a vast, oscillating ocean. For years at a time, the waters can remain calm, the winds favorable, and the ships representing our portfolios, nations, and corporations sail aggressively toward the horizon of growth. But history, with its cold indifference, guarantees that storms will come. When the skies darken, when geopolitical fault lines rupture, or when credit cycles violently contract, the priority shifts instantly, from speed to survival. This is the moment of the safe haven. Welcome to this deep dive into the architecture of financial safety. Today we are not just looking at assets that go up when others go down. We are exploring the psychological anchors and liquidity providers that defy the gravitational pull of panic. As we navigate the mid-2020s, a period defined by the fragmentation of global trade and the rise of digital sovereignty, the definition of safety is undergoing its most radical transformation since the end of the Bretton Woods system. To understand where to hide when the market crashes, we first need to dissect the philosophy of safety itself. There is a critical distinction that novice investors often miss, and that is the difference between risk and uncertainty. These are not the same thing. Risk is the roll of a die. We know the odds of rolling a 6 are 1 in 6. Financial markets are actually very good at handling risk through interest rates and insurance premiums. Uncertainty, however, is what economist Franc described as unmeasurable risk. These are the unknown unknowns, the events for which there is no historical precedent. Safe haven assets are specifically designed for Nietzschean uncertainty. You do not own them because you calculate a specific probability of disaster. You own them because the probability of disaster is never zero. A true safe haven stands on 3 pillars. First is negative correlation. This means the asset must rise specifically when the world is burning. If it rises during a boom and stays flat during a bust, it is merely a defensive asset, not a safe haven. Second is liquidity. True safety requires convertibility. In a crisis, cash is king because it is the ultimate settlement instrument. A rare painting might hold its value theoretically, but if you cannot sell it instantly without a massive price cut, it fails the test. Third is functional independence. A safe haven must not rely on the solvency of a counterparty that is likely to fail. This brings us to the asset that has been the ultimate arbiter of value for 5,000 years: gold. Gold's status is not derived from cash flow or dividends, but from its scarcity and its independence from the financial system. It is no one's liability. However, the mechanics of the gold price are often misunderstood. Most people think of gold simply as an inflation hedge, but the data paints a more nuanced picture. Gold is primarily a hedge against real interest rate repression and currency debasement. When interest rates, adjusted for inflation, are high, gold becomes expensive to hold because it yields nothing. But when real rates are negative, meaning inflation is higher than the bond yield, gold shines because holding cash guarantees a loss of purchasing power. Beyond the math, gold carries a fear premium. During the 2008 financial crisis, the pandemic, and recent geopolitical escalations, gold prices spiked, not just due to inflation, but due to the fear of systemic collapse. A critical shift occurred in the early 2020s that changed the gold market forever. Following the freezing of Russian central bank assets by Western nations in 2022, the concept of neutral reserves moved to the forefront of global economics. Central banks in emerging markets like China, India, and Poland realized that U.S. Treasury bonds, while liquid, were politically exposed. Consequently, they began aggressively accumulating gold. This structural buying has created a floor for gold prices, insulating it somewhat from high nominal interest rates. For the average investor, however, there is a distinction between paper gold and physical gold. In a true doomsday scenario where clearinghouses fail, paper gold derivatives are merely a claim on a bankrupt entity. This is why sovereign entities continue to repatriate physical bars to domestic vaults. Now, let's move from hard metal to the fortress of fiat currency. In a world of paper money, safety is relative. When investors flee risky markets, they do not always flee to hard assets. Often, they run to the cleanest dirty shirt in the laundry pile. This explains the dominance of the US dollar. The dollar defies simple logic. It is the currency of the world's largest debtor nation, yet it remains the primary safe haven. This behavior is explained by the dollar smile theory. Imagine a smile. On the left side, when the global economy crashes, investors panic and sell emerging market stocks and debt. They need to park that cash somewhere liquid, and the US Treasury market is the only market deep enough to absorb trillions of dollars instantly. Thus, in a crisis, demand for dollars surges. On the right side of the smile, when the US economy is booming relative to the world, capital flows in to capture growth, also strengthening the dollar. The dollar only weakens in the middle of the smile, when the US is muddling through while the rest of the world recovers. Despite concerns over the massive US debt load, the dollar's role as the global invoicing currency for oil and trade ensures that in a liquidity crisis, the world needs dollars to pay debts. This creates a short squeeze on the dollar, reinforcing its safety status. But the dollar is not the only game in town. The Swiss franc acts as an alpine bunker. Its status relies on fundamentals that are the inverse of the US: a massive current account surplus, low government debt, and political neutrality. Then there is the Japanese yen, perhaps the most complex safe haven. Its status is not based on Japan's economic growth, but on Japan's status as the world's largest net creditor. Japanese investors hold trillions in foreign assets. When markets are calm, they sell yen to buy foreign bonds. This is the carry trade. But when panic strikes, they repatriate those funds, selling foreign assets and buying back yen. This sudden surge of buying pressure causes the yen to skyrocket during crashes, even if the Japanese economy itself is struggling. Traditionally, alongside currencies, we hold sovereign debt. Government bonds, specifically US Treasuries and German bunds, are the bedrock of the traditional portfolio. They offer the promise of return of capital. Mechanically, when stocks crash due to a darkening economic outlook, central banks cut interest rates. Since bond prices move inversely to yields, rate cuts cause bond prices to rise, acting as a shock absorber for a portfolio. However, 2022 broke this correlation. Inflation soared, forcing central banks to raise rates into a slowing economy. Stocks and bonds fell together, terrifying investors. The lesson from the mid-2020s is clear. Bonds are a perfect hedge during a deflationary crisis, like 2008 or 2020, but in an inflationary crisis, they can be the source of risk. In Europe, the German Bund commands a scarcity premium because the German government runs fiscal surpluses, creating a shortage of high-quality assets during times of Eurozone stress. Now, we must address the digital frontier, Bitcoin and crypto. The debate over Bitcoin as digital gold is heated. Its primary claim to safety is similar to gold. It has a fixed supply and cannot be debased or easily seized. In nations with failing currencies like Venezuela or Turkey, Bitcoin has undeniably functioned as a life raft. However, in efficient global markets, the data from the first half of the 2020s tells a different story. Bitcoin has historically traded with a high correlation to speculative tech stocks. When liquidity is abundant, it soars. When the Fed tightens, it crashes. While the introduction of spot ETFs and institutional adoption is beginning to dampen its volatility, the verdict for now is that Bitcoin is a call option on a new monetary system, not necessarily a stabilizer for the current one. It belongs in a portfolio for growth and insurance against total fiat collapse, but it cannot yet be relied upon to dampen volatility in a standard recession. For those who want to stay in the stock market but reduce risk, we look to defensive equities. These are companies whose products are necessary for survival. Consumer staples like toothpaste and food, utilities that provide electricity, and healthcare providers all tend to maintain earning stability during recessions. In the geopolitical climate of the 2020s, the defense industrial base has also emerged as a distinct, safe haven sector. With global military spending rising, companies manufacturing defense equipment have order books guaranteed by governments years in advance, decoupling them from the broader business cycle. When paper money loses credibility entirely, we turn to real assets. Real estate is an excellent long-term inflation hedge, but it is highly illiquid. You cannot sell a bedroom to buy groceries. The true safe haven within this category is farmland. It produces essential commodities, has a finite supply, and historically performs well during inflation and war. Similarly, strategic commodities, like energy and food, act as hedges against supply shocks, though oil can be vulnerable during a deflationary demand collapse. We must also consider the psychology of panic. To use safe haven assets effectively, one must understand the liquidity trap. In the initial moments of a crash, everything sells off. Gold falls, bonds fall, stocks fall. This happens because leveraged funds receive margin calls and must sell whatever is liquid to pay their debts. Gold is liquid, so they sell it. This creates a counterintuitive drop in safe havens. The seasoned investor knows this is a buying opportunity. Once the initial margin calls are met, safe havens are the first to rebound. So how do we construct a fortress portfolio? The goal is risk parity, balancing the portfolio by risk contribution. A modern resilient portfolio might look like a mix of global equities for growth, defensive equities for stability, sovereign bonds to protect against deflation, gold as insurance against fear, and a small allocation to digital assets for asymmetric upside. Another approach is the barbell strategy, holding ultra-safe assets like cash and gold at one end and high-risk growth assets at the other, while avoiding the mediocre middle of corporate bonds. Looking to the future, the definition of safety will continue to evolve. We are moving toward a multipolar financial system where safety may become regional. The US dollar will remain king in the West, while the BRICS nations may increasingly rely on gold and commodities. Furthermore, as central bank digital currencies, or CBDCs, become a reality, the premium on physical cash and physical gold may rise as they become the only assets outside the digital surveillance grid. Finally, safety is becoming physical. We are seeing the rise of climate-safe havens, geographic regions in temperate, water-rich zones that are insulated from extreme weather. In conclusion, the search for a safe haven is the search for certainty in an uncertain world. There is no perfect asset. Gold pays no interest. Bonds can be ravaged by inflation. Cash is eaten by debasement. The only true safe haven is a combination of diversification and liquidity. By holding a balance of assets that react differently to the four economic seasons, inflation, deflation, growth, and recession, you build a ship that is not designed to avoid the storm, but to ride through it. In the economy of the future, the winner is not the one who takes the most risk, but the one who survives the longest.